In recent years, options trading has gained immense popularity, with the cloud of quick riches and hope to achieve financial freedom. This false facade, which is easy to make high returns in a short span, has driven many to venture into this complex financial genre. However, beneath the glitter of social media success stories and influencer hype lies a harsh reality: losses, big losses. A recent study has also revealed that a significant majority of these people losing are young retail investors. The study, which analyzed trading accounts from major brokerage firms, found that nearly 85% of young traders incurred losses within their first year of trading options. Experts attribute these losses to a lack of understanding of option strategies and the influence of social media hype. Social media platforms are flooded with videos, vlogs, and posts showcasing extravagant profits from options trading. Influencers flaunt their gains, often with screenshots of substantial profits, creating an illusion of effortless wealth. Unfortunately, many young traders, driven by the fear of missing out, FOMO, dive headfirst into options trading without a clear understanding of the inherent risks, and missing the point that these screenshots may be fake. One common trap is the underestimation of the complexities involved in options trading. Unlike straightforward stock trading, options require a nuanced understanding of market movements, volatility, and time decay. New traders, swayed by the promise of quick gains, often neglect these critical factors. This leads to poorly informed decisions and significant losses, especially with the buyers of naked single leg options. Essential tips for young traders. 1. Educate yourself thoroughly before diving into options trading. Take the time to learn the basics. Understand how options work, the different strategies involved, and the risks associated with them. There are numerous online courses, books, and tutorials available to help you. 2. Don't trade single leg options. Getting the direction right in markets is probably one of the toughest things to do. Trading single leg options not only forces you to be right in direction but makes you dependent to do this in a short span of time as well. Hence it is always advisable to trade hedged strategies that are lower in terms of risk. 3. Risk management is key. One of the biggest mistakes young traders make is neglecting risk management. Use hedged strategies to limit your losses and never risk more than you can afford to lose on a single trade. Diversify your trades to spread risk. Ideally, more than 3% of your capital should never be risked in a single trade. 4. Avoid overtrading. Overtrading is a common pitfall for all. It's easy to get caught up in the excitement of markets, but making too many trades can lead to increased transaction costs and higher risk. It also sometimes leads to having a revenge mentality. Be selective and patient with your trades. Another common mistake that leads to overtrading is short-term success. Having a few profitable trades makes the average participant feel like they know something that others don't. There is always a systematic learning curve that is applied in any area of life. You start from the basics, then graduate to intermediate, then higher stuff. Just like you start off schooling with kindergarten, 10-2, graduation and further on. Similarly, if you are into sports, you do not become an overnight champion, you work towards it from the very basics. As a beginner, in the same way, as a beginner, you cannot start option trading on day one, as this is one of the more advanced levels of learning in the stock market. You first start with the cash market, understanding the nuances of how stock prices move fundamentally, or technically, whichever suits you. Start deploying small amounts. This is of course based on your own capital availability and risk appetite by investing in stocks in the cash market. Simultaneously, read up as much as you can on how futures and options work. Once you are comfortable with the cash market, you start observing option prices along with stock prices and assess other related data. Then you deploy small amounts of capital in options and keep tweaking your methods based on your experience, so on and so forth. This is the cycle of learning after all. Thank you.